We all own ETFs and mutual funds inside of our portfolios, but do you really know what's inside of them? We uncover this and more in Research by Potomac.
Okay, hey everybody, welcome back to another episode of Who Charted, the most exciting 6 minutes in markets. There's a lot going on here. We're going to touch on the things that are on our radar screen. I think it's an interesting time in the market actually because, if you're bullish, there's a lot of data points out there that you can point to support your case. And if you're bearish, there are a lot of data points that you can point to support your case. So with me as always, is Drew Wells. We're going to go through the charts that are on our radar here this week. Drew, what do you have for us?
All right, if you're managing client money, chances are you have stocks and bonds in your portfolio, right? Not a very earth-shattering statement there. So one of the most useful ratios, in my opinion, one of the most useful charts out there that you should be paying attention to is the ratio of stocks to bonds, okay? So this is a Vanguard Total Stock Market Index relative to the Total Bond Market Index. Again, we've shown this chart a couple times on the show here. I wanted to show the long-term chart for a couple of reasons. Number one, because the long-term view is still in an uptrend for stocks relative to bonds above that 200-day moving average right there. But over the last couple of years, we've definitely been chopping around in that range. So for those of you who might be on a little bit of a shorter-term time frame, you're definitely going to want to pay attention to where that ratio is located in that range right there. So interesting note that we did hit an overbought print on an RSI, kind of coming down off that momentum range right there. So I would look for that 200-day moving average to be tested again to the downside. So if you are making a decision in portfolio management for stocks versus bonds, it's definitely one to pay attention to.
All right, my first chart here is kind of plain vanilla, the S&P 500. Now, everybody in the market is focused on the 200-day moving average, or what roughly equates to the 40-week moving average. We show the 40-week moving average in a lot of the work that we do, but we also pay close attention to the 65-week moving average. It's not as widely followed as something like the 40-week or the 200-day moving average. But, for all intents and purposes, the 65-day moving average roughly lines up slightly above the 200-day moving average right now. And what we can see here on this weekly chart is that last week's rally met that 65-week moving average. We're paying attention to it, especially in light of some of the breadth thrusts and improvements in breadth that we've been highlighting. However, did not get through, actually faded from that 65-week moving average to close near the low of the weekly range. Now, we have been talking about incrementally bullish trends within the market. The next step is really for the S&P 500 to get above, convincingly above, the 200-day moving average or the 65-week moving average. Not there yet.
All right, growth to value. This is a really interesting relationship that I like to look at. Obviously, large cap growth has been doing very well relative to large cap value. ARK relative to the deep value ETF deep here. This is the two extreme ends of the growth to value relationship, or what could be considered the two extreme ends of these relationships here. So, interesting thing is we're not seeing the same strength out of this relationship that we have seen large cap growth relative to large cap value. Ratio hitting relative resistance there, again, declining through that 50-day moving average, the downside, now starting to roll over to the downside. Take a look at RSI in the bottom pane there, again, hitting that upper bound, that 60 level, unable to break through there and kind of rolling over again. So if you're a really big growth bull, this is a relationship that you want to see, one of the riskier relationships that you want to see turn to the upside. Haven't seen that turn yet. So a lot of the other relationships that we look at are working, unfortunately not this one.
All right, this chart is making a repeat performance from the last show. It is the dollar index. There has been a pretty solid correlation between the dollar and risk-on, risk-off behavior in the market. As the dollar is strengthening, it's generally a sign of risk-off behavior. As the dollar weakens, it's generally a sign of risk-on behavior. Now, the dollar index gets up to about 109 back in June and then starts to back off down to the 105 level, 104.50 level. That's a big move in currencies, right? And when that move was playing out, as the dollar was weakening, risk assets caught a bid. But look at what happened last week. We get this pump to the upside for the dollar index as the averages are kind of hitting key resistance levels and unable to break through. We drew this line in the sand here at the 103 level for the dollar index. Above 103, it's probably more likely a risk-off environment. Below 103, it's more likely a risk-on environment. So I know this chart is making a second appearance here in as many shows, but I do think it's that important. It's on our radar screen. We're watching it closely.
All right, does everybody remember when a lot of investors wrote energy off, starting in the third quarter of the year here there? It's kind of funny to see this relationship kind of break up back to the upside of the 2400 level. This is equal weight energy. Again, in their traditional energy index, Exxon and Chevron make up roughly half the weight of the whole sector there. So we look at equal weight energy as a better gauge for the performance of the average energy stock. Again, breaking above that 50-day moving average. Notice how the sector, the average energy stock, sort of found support throughout the past year at that rising 200-day moving average, right, which we never really materially started to break down below. So relative to equal weight S&P 500 on the bottom pane here, starting to break through that declining 50-day moving average of the ratio, rising out of relative support. So, energy could be making another turn for the highs again here after everybody wrote them off.
All right, rates are obviously on everybody's radar screen as well, ours included. Jackson Hole meeting this week, all eyes and ears on Chairman Powell. My eyes are going to be on the relationship here at the top of this chart, base metals versus precious metals. And generally speaking, there is a positive correlation. If base metals are outperforming precious metals, you tend to see the 10-year yield going higher. Now, what's interesting to me is that the high in the 10-year yield at about 3.5% back in mid-June was not confirmed by this ratio. The base metals to precious metals ratio did not make a new high. Rates promptly backed off down to about 2.6, 2.5. But now look at what's happened here. Base metals finding a bottom at support against precious metals and starting to work higher once again. So with Jackson Hole this week, obviously rates, there's going to be some volatility there. I'll be watching this ratio. If this ratio continues to move higher, I think it stands to reason that there is upside through the 3% level, maybe even through that 3.2% level that a lot of people are watching on the 10-year yield. So that one is on our radar this week.
All right, everybody, if you like this kind of content, be sure to like and subscribe. Thanks so much for spending some time with us, and we'll see you next video.
Thanks, everyone. See you soon.